When most traders look at the options market, they see calls, puts, and prices flashing across a screen. But what professionals see is entirely different. They see risk flows, hedging pressures, and hidden levels where markets are likely to stall, reverse, or accelerate. These levels aren't shown on any broker's chart. They don't appear in basic technical indicators. They're the result of delta and gamma hedging models that banks and hedge funds run in real time. And today, I'm giving you an advanced guide to how these delta and gamma levels shape the options market, and why they're critical if you want to trade like a professional. Welcome to Derivatives Trading Mentorship, where we bring you the strategies used by market makers and institutional desks. If you want access to our proprietary delta and gamma hedging data, visit www.derivativestrading.com. Your edge in today's options-driven markets. Why delta and gamma levels matter. First, let's define what these levels actually represent. Delta hedging levels are points where market makers and dealers must buy or sell the underlying asset to remain neutral. Gamma levels show how sensitive those hedges are to changes in price, which means they highlight where hedging flows can accelerate moves dramatically. In short, these levels are not guesses. They are mathematical thresholds that directly influence how much stock, futures, or ETFs must be bought or sold in response to options positioning. And when you know them, you can anticipate market behavior with precision that technical analysis alone simply can't provide. How market makers use them. Imagine a dealer sells a large block of call options. That creates short delta for them. To hedge, they buy stock. Now as the stock moves closer to the strike price, gamma kicks in. Delta changes faster, forcing them to buy even more stock. This creates a feedback loop, fueling rallies when the market pushes through key levels. The reverse happens when puts dominate, driving forced selling. This is why gamma levels often align with intraday volatility zones, spinning prices near certain strikes or unleashing sudden squeezes. For market makers, these adjustments happen automatically. For you as a trader, recognizing the same levels means you can trade alongside the flows instead of against them. The mechanics of delta and gamma levels. Here's what advanced traders look for. High open interest strikes. Options with massive open interest concentrate hedging pressure around those strikes. Gamma flip zones. These are price levels where dealer positioning changes from long gamma to short gamma, flipping the way hedging impacts the market. Dealer net positioning. Are dealers net long or short options? This determines whether their hedging adds liquidity or removes it, making moves sharper. Volatility impact. Gamma is higher in short-dated options. That means weekly expirations often create the most violent hedging flows. These mechanics are why you'll often see markets pinned to certain prices into expiration or explode away from them when liquidity breaks. Applying this as a trader. So how can you use these levels without being a market maker? Identify key strikes. Look at where the largest option positions sit. These often act as magnets for price. Watch gamma exposure. If gamma exposure is high, expect reversion and pinning. If it's low, expect more volatility. Track flows into expiration. Hedging pressure grows as options approach expiry, making certain days far more reactive. Overlay with technicals. Combine hedging levels with support, resistance for higher accuracy. This doesn't mean you're predicting the future. It means you're aligning your trades with the same mechanics driving institutional flows. Why we provide proprietary levels. At Derivatives Trading Mentorship, we calculate delta and gamma hedging levels using proprietary models the same way banks and funds do. Our clients get daily updates on where the most critical levels sit, levels that can't be seen by simply scanning an options chain. This gives traders a framework to anticipate volatility, understand where liquidity providers must hedge, and position intelligently. If you want to stop trading blind and start seeing what institutions are watching, visit www.derivativestrading.com. The takeaway. Delta and gamma hedging levels are not just theory. They are the invisible hands shaping every move in today's option-driven markets. Delta tells you where dealers must hedge. Gamma tells you how aggressively they must do it. Together they create the roadmap that hedge funds and market makers follow. When you understand these levels, you stop chasing random trades and start trading with institutional awareness. That's the advanced guide, and it's just the beginning. If this video helped you see the market in a new light, subscribe. Now to Derivatives Trading Mentorship. We'll keep uncovering the strategies hedge funds use so you can trade smarter with confidence. And remember, in derivatives trading, knowledge isn't just power, it's protection.